Good afternoon, and a warm welcome to the Bill Gallagher room. Thank you very much for joining us. My name is Guguletu. My wonderful co-host is Herman, and it is our great pleasure to have you here. It's hard to believe we're in the last of the concurrent sessions. After this, of course, there is plenary, and then there is the cocktail evening with Celeste and Duli. But before that, we have a full panel, which is our first full panel of the day, with a fascinating conversation.
Yes, we're very much looking forward to this next topic, and it's Insuring the Uninsurable, Enabling Regulation for Pooling Arrangement. So we're joined today by Mohammed and Marius, who have authored this for us, and then they are joined on stage by Vivian Pearson from SAIA and Yusuf Bodiat from the African Risk Capacity. So thank you very much. We're looking forward to the discussion, and please take it away.
Good afternoon. We are here to argue the case for pooling arrangements in South Africa as an alternative risk transfer mechanism. You'll see that it differs from the traditional insurance model of a policyholder expecting an insurer to take on the risk and the insurer offloading that risk to a reinsurer, and in some cases the international reinsurance market through retrocession agreements. And typically pooling arrangements are used in cases where there's a catastrophic type risk underlying that particular policyholder's identity or business model. So 2 weeks ago, Hurricane Melissa hit the Caribbean. It is coined a Hurricane 5 or Category 5 hurricane, coined one of the worst natural catastrophe disasters in recent years. Wind speeds of up to 280 kilometers an hour and severe rainfall that caused significant damage. That was 2 weeks ago. Last week, Friday, the Caribbean Catastrophe Risk Insurance Facility, a pooling arrangement, announced that it's going to pay out $71 million, literally within a week, essentially, from when the event happened. And these two slides, luckily for us, summarize our whole presentation and paper, which is the value of pooling arrangements. In this case, a natural catastrophe pool, but as you will see, there are globally many types of pooling arrangements for different types of risks. When Mo and I started doing research on pooling arrangements, we quickly came to the conclusion that there isn't a material body of research available on pooling arrangements in South Africa. And that is why we decided to embark on a journey to write a paper about it. And we came to the conclusion that South Africa, unfortunately, whilst we are a sophisticated insurance market, only have one pooling arrangement in the form of the South African nuclear pool that is operative today. Vivian will share with you an example of Sastria's business model before this. But today, Sastria is a state-owned insurance company. But first things first, let's start with the definitions. So what do we mean when we talk about catastrophic risks? For those of you who are parents, I'm the dad of a teenager, and whenever I walk into my son's bedroom, I hear my wife go, "This is a catastrophe, another hurricane that swept through. It's your responsibility to help with the disaster cleanup." So that happens on a regular basis, but that is a catastrophe of a smaller scale. Closer to the definition that we want to use is the recent French catastrophe, the Louvre heist. Apparently, the value of the jewelry stolen was more than $100 million, which is more than the payout of the Caribbean Catastrophe Risk Insurance announced last week. Unfortunately for the French government, because they always do things differently, they decided to self-insure all the assets held in their museums. So in this case, the insurance industry is not under pressure to pay out. But the type of catastrophes we talk about, the obvious one is natural catastrophes. This is a slide from Allianz that shows the extent of losses from natural disasters in 2024 alone. They range between $1 billion and at the top end, $94 billion in total economic losses from a single event. The largest insured payout was in US convective storms and that was 51 billion US dollars. Clearly explaining also and highlighting the value of insurance in the event of natural catastrophes. To us, it came as a surprise that there isn't a natural catastrophe pool in South Africa, even though government has been encouraging the creation of one or participation in such pooling arrangements. But it's not only found or used in natural catastrophes. The other types of risks that we would classify as catastrophic risk in insurance is nuclear, aviation, marine, and terrorism. I'll talk about the employee benefits one a little bit later. So our definition of catastrophic risk from an insurance perspective is these category of risks that would be too large for a single insurer to assume the risk and then through the reinsurance market achieve sufficient diversification to take on the risk. Natural catastrophe one is the easier one to think about, where no single insurer necessarily wants to take on the risk on its own. Our traditional reinsurance market also doesn't want to take on the risk. And so pooling arrangements came about as a solution to solve for these types of catastrophic risks, and we'll explain how they work later. The next question then becomes, so why don't we have many pooling arrangements in South Africa? And who is to blame? Now, there's two sides of the coin. Clearly, from a government perspective and from a policyholder perspective, what we don't want to see, especially in a well-developed market like South Africa for insurance, is that there isn't enough cover for policyholders in the case of catastrophic events. The other side of the coin is that you cannot blame the insurance industry for not wanting to provide cover for these large catastrophic events. There's many reasons for it, but one in particular would be the onerous capital requirements imposed by the regulator. And what we found was that South Africa actually has no incentives to the industry to actually participate in these pooling arrangements. Now, in many markets globally, we see either the regulator providing some form of government backstop, some form of incentive to insurance companies to participate in pooling arrangements. In some cases, the pooling arrangements are set up through mandatory structures enforcing participation from industry. But you'll also see that we'll give examples of where private market has solved for it on a voluntary association basis, and therefore you don't necessarily need government intervention. And our argument is, in a South African context, especially given the constraints in our fiscus and the particular unique needs in our market, we should be solving for these risks on a voluntary association basis and not wait for government through enforced regulation, enforcing essentially the creation of these pooling arrangements. So that's catastrophic risks. Now, let's get to pooling arrangements. We have one famous pool in South Africa, Nkandla. Apparently, this one was set up for an insured peril, fire risk or hazard, which we all as taxpayers contributed to. But we are not talking about this particular type of pool. Insurance pooling arrangements or reinsurance pooling arrangements can rather be described through the metaphor of our government of national unity. It's essentially an association of insurers coming together on a formalized basis to solve for a particular type of specialized risk cover. In a pooling arrangement, each of these insurers would still retain their own identity, but part of the cooperation agreement that they typically sign and commit up to is that they will commit a certain amount of capital up front every year. The total amount of capital committed is communicated to the policyholder. That will signal to the policyholder how much risk can be insured. The rest would remain self-insured. They would typically also have in their voluntary association rules clauses that state who would be the lead underwriter, like we have in a government of national unity, the party that would take the lead in assessing the underwriting risk, and also play a leading role from a claims management point of view in the event of claims payout, coordinating across the participating insurers what to do. It is important to highlight that this is different from the co-insurance or syndication model part of the market. So we do have arrangements in South Africa where, for example, large corporate clients may have very large risks. Through a process of syndication where corporate brokers would place the risk with different insurers, you would end up spreading the risk. But in syndication, usually each party would quote their own premium, their own assessment of the risk that they have performed, and individually negotiate through the broker with the policyholder. Pooling arrangements are different in that there would be usually an appointment of an intermediary or a broker company or an administrator in some markets that would represent all the participating insurers in the pool. That administrator, on behalf of the insurers, would negotiate with the policyholder or the broker and also facilitate discussions with counterparty pools in other jurisdictions. I'll give an example of that later. And there's one price communicated to the policyholder, and then the risk is divided up according to the commitment of each of the participating co-insurers. What that means is much smoother administration. It's one premium that gets collected from the policyholder and then is managed and divided up by the broker or the intermediary, etc. And then from a claims administration point of view, the inverse would apply. If we explain this diagrammatically, in a co-insurance model, the level of diversification would happen at this insurer level in the first layer. Then some of the insurers would reinsure and some of them would transfer some of the risk into foreign insurance markets. Pooling starts with the same first layer of risk diversification, with the difference that this is done in a formalized basis through the creation of these associations. In some markets, for particular types of risk, this layer of diversification is already achieved actually through the registration of a specific legal entity. In a South African context, given our overlapping of the Companies Act and the insurance regulatory regime, we don't have the benefit of creating legal frameworks for pooling arrangements. And so we are left with voluntary associations, and we'll explain, for example, the South African nuclear pool model as an example. They would then appoint an administrator company that is usually represented by a pool manager, an individual that is then full-time or semi-full-time, responsible for managing the affairs of the pool. And then there would be the set of pool rules already referred to managing the relationship amongst the parties. The same principles of further diversification of risk apply. Each of these participating insurers can decide how much of that risk they would transfer to the reinsurance market. But this is where an interesting nuance comes in with pooling arrangements. In pooling arrangements, of which we have the one in South Africa, the first layer of insurance diversification already involves the offshoring of risk to foreign insurance markets, not through the traditional reinsurance model. Top right, you'll see we've marked a foreign insurance pool. If it is, for example, the case of terrorism, you might have a pool in one country sharing risk with a pool in another market specializing in terrorism as a class. You can also achieve the same on a direct participation notice through foreign reinsurance pools if that country's legislation allow the reinsurers to directly underwrite, of which there are some examples. If we go through the different types of pooling arrangements, nuclear insurance essentially started with the evolution of, let's say, nuclear energy from an innovation point of view. It was established in terms of convention through international conventions, the liability frameworks were established through international conventions. Paris for Western countries, Vienna for other countries, and each country would sign up to being a participant in the convention. That would then be enforced through local regulations, in the South African case through the Nuclear Energy Act. And our local act prescribes very strict financial liability limits that apply to our nuclear power plants, Koeberg and Pelindaba. And the policy, or the owner rather, of those power plants would be government through Eskom and NECSA, and they would be responsible for obtaining those forms of cover for the financial liability, which in our case happens through insurance arrangements. The same would apply to nuclear operators globally in other jurisdictions, but a very important difference in terms of other types of pooling arrangements to the global system for nuclear pools is that nuclear pools operate on a reciprocal basis. What that means is the nuclear power plant, for example, in Switzerland, Japan, China, in other countries, would transfer some of their insurance risk back to the South African pool, or vice versa, between Japan and Germany, or Germany and Japan. And that is the process through which, through pooling arrangements, not through a traditional reinsurance market, you get sufficient spread or diversification of risk so that you can ultimately insure this category of risks, reduce premiums, and ultimately, also through capital requirements, end up with some gain. Despite a sophisticated global network of nuclear pooling arrangements, there's still not enough insurance capacity, and so there's an element of self-insurance whereby even our South African nuclear operators, our two state-owned entities, for example, would be participants of self-insurance arrangements in Belgium for the remainder of the risk that is not covered. Aviation has an interesting history. Aviation pools effectively started more as a reactive response post-World War II, clearly with the amount of damage caused to various governments and their defense operations. Again, international regulations or conventions play an important role. There's very strict liabilities defined in these conventions. You need insurance cover not only for the air carriage, but also for passenger liability. The USA, for example, has a different dispensation, similar concept in terms of pooling arrangements. They call it risk retention groups. And so you can see for each one of these types of risks that there's similar principles, but each market have solved for it in a different way. Marine as a category of risk is typically covered through P&I clubs. It's got its history in the UK market through the shipping industry, more weighted towards self-insurance mutual arrangements in terms of its pooling structure, so not-for-profit type of pooling arrangements. So also an interesting model to look at. Terrorism was set up also in response to the September 9/11 attacks in the USA, and we only saw the emergence of terrorism pooling arrangements globally after this. What was different here is that many of these pooling arrangements were set up through public-private participation partnerships, as opposed to just solving for it on a mandatory basis from a government perspective or through private market alone. And we've given you some examples there. You may have a question about Sasria. Sasria today is a single state-owned insurer, but Vivian will talk to its history as a pool. So in our view, in the paper, we don't classify this as a pooling arrangement anymore because it's not done on a co-insurance basis amongst participating insurers. On the employee benefits example, just quickly, some of you may have come across employee benefits multinational pooling arrangements. We can have a debate as to whether this classifies as a pool or not. In our view, it's typically not done through a formal pool arrangement, even though it's called a pool, but basically for a particular multinational company, like a large mining group, each subsidiary entity would insure its very large employee benefit sums assured with a particular insurer in that market. It would then typically, through a single reinsurer globally, pool the risks. And this is more of an economic participation or value share arrangement, whereby profit share is then extended to the different participating insurers, ultimately the policyholder. So it's done on a quasi-formalized basis, but it uses the traditional reinsurance market and not pooling as we would define it. I'll end off with this slide before handing over to my colleague. The only comprehensive summary of the number of pooling arrangements we could find was a paper from AXA published in 2018. So unfortunately, it is a bit old, but at that stage already, 451 pooling arrangements that were counted globally. What you'll pick up if you go across the columns is by region, the number of pooling arrangements, and then by line, you'll see the different types of pooling arrangements. Most of the pooling arrangements you can see have been formed around natural catastrophe type disasters or perils. For Africa, interestingly, you'll see 78 pooling arrangements. And essentially our question asks the paper, If we have such a sophisticated market and we've got the strength of so many strong insurers' balance sheets, why do we only have one insurance pool in South Africa?
Thank you, Morris. Afternoon, everyone. As can be seen on the slide, pooling arrangements is not a new concept. Some of these pools have been established since the times of World War II, but you'll notice that the biggest type of pool, or the most prominent type of pool, are natural catastrophe pools, forming 84 out of the 451 pools. So we have a slide here that shows where the bigger of these natural disaster risk pools operate. They operate worldwide. We have the African risk capacity, which operates across most of Africa, as the name would suggest. And that speck there, that little blue speck in South Africa, is not a mistake. Lesotho is actually a signatory to the ARC. We are not. And we brought Mr. ARC, the head of finance and investments here. He's going to answer the question as to why. Seems like it's more effort to exclude us. They're already in South Africa. No, the reason is we're the problem. It's not them. But he'll explain more. These pools have been quite active. We just started off with an explanation of CCRIF, who paid out 71 million for the Jamaica hurricane very recently. ARC similarly has made massive payouts since its inception of 170 million, and the Pacific Caribbean region and the Southeast Asia disaster risk insurance facilities have similarly made out quite a few payments. The amount of pools that we show on the slide shouldn't distract from the fact that there is a big need for insurance for natural catastrophes. Over the past decade, the number of uninsured, or the percentage of uninsured losses due to natural disasters, was 62%. So that means that more than half of the damage that occurred from natural disasters was not covered by an insurance payout, and the policyholders had to just take the burden of that risk on their own. The USA recently had quite a few wildfires in California, and since then, 7 of the largest insurers have stopped offering homeowner cover in that region as well, leaving a lot of households uninsured again. So we would not like to end up in a similar position as South Africa. Before we move on to a bit more of how these natural catastrophe pools operate, we explain parametric cover. These pools operate mainly on parametric cover, and this cover is designed to have a fast payout in the need of immediate funds. It does this by having a defined payout. So the payout is not indemnity-based, as is the case with your motor insurance, for example. They'll try and cover you for the loss that occurred. In this case, the payout is defined upfront, and the insurers know exactly how much they will pay out. A trigger event is based on something that's easily measurable and objective. So, for example, wind speeds exceeding X kilometers per hour, sustained for Y amount of hours, that will define a trigger event. Someone will be monitoring this, and as soon as this happens, the insurance company pays out the defined amount of cover to the policyholder. This obviously means we have immediate payouts. It's very efficient for natural disasters because sometimes you don't have time to phone OUTsurance, for example, and tell them, hey, I've been in an accident, and wait for the loss assessment. I'm just getting OUTsurance. You guys are here. You guys are great. You're very quick. But it is definitely quicker than the normal type of insurance that we're familiar with. And it has the added benefit of a lower cost of admin, just due to the simplified structure and the less admin systems that are needed to monitor claim events. Marius touched on different types of pools, and he mentioned that the word pool can sometimes be used a bit loosely. We're going to give 2 examples of natural catastrophe pool structures that we've seen in the market. This one is based on the way African risk capacity operates. So we have policyholder A, B, and C, and each of these will be represented by their respective governments. So it needs to be a bigger policyholder. For example, this will be a municipality within a country that will be represented by its government. These governments will come together and set up a captive NatCat insurer, usually in a foreign jurisdiction, and they will then all pay premiums into this captive insurer, and that insurer will then provide parametric cover to each of the governments that were signatories to this treaty and paid premiums out to them. This insurer is then free to cede their cover out to other reinsurers as they see fit in the foreign sphere. Another type of NatCat pool structure that we've seen is based on mandatory cover. So in this case, we have 3 policyholders, and these policyholders can be us, normal people who have insured their homes. So they will go out and get insurance cover with independent insurers, and these insurers will then be mandated, usually by a government or by a regulation, to go and seek reinsurance cover for a specific peril with one specific reinsurer only. And the government will then come in and act as a backstop. For any claims that exceed that amount, the government will step in. The benefit of this is that you don't cede any of the premiums out, so you keep all of the profits within the country, but obviously you need to have a really strong balance sheet to be willing to take on this risk. This leads us to this slide. The World Bank published a working paper recently in the G20 summit in July, defining these PPIPs, which stands for Public-Private Insurance Partnerships, very similar to triple P structures, public-private partnerships, where the government and the private parties come together to form an insurance to solve for a specific need. And they define them on a spectrum. So on the lower end of the spectrum, you have countries or structures where you have a low level of market sophistication, financial market sophistication, and a very weak financial capacity of the government, so not a strong balance sheet. On the other end of the spectrum, you have structures where you have a high sophisticated environment, a highly sophisticated financial environment, and a strong balance sheet for the country to take on their specific risks. So in our examples earlier, the first one, where we had different governments that set up an insurer somewhere in a foreign jurisdiction and they would pay parametric insurance premiums to that insurer, that would sit here. The African Risk Capacity has a lot of international aid through the World Bank that they will fund as well premiums, and the international aid sphere will form part of that group. The second example that we've shown, where the government comes in as a backstop, would form part of the upper end of the spectrum, where you have a strong private market insurance, because you would need to first go and seek private insurance for yourself, and then also a really strong government that can act as a public player and come in as an insurer of last resort. Where does South Africa stand? At the moment, we're a little bit exposed to natural catastrophe risks. Marius touched a lot on the regulations in the country and how they can be a limiting factor to adopting pooling structures. So currently, the only pool structure we've got is the South African nuclear pool, which does not offer natural catastrophe risks or risk cover. And natural catastrophes in South Africa have been worsening. So we have a graph here that shows the amount of natural disasters in South Africa over time. I fitted a really aggressive polynomial to the flood, just to make my point. It's probably not very accurate, it's not mathematical, but it makes the point that there is an increase in the number of floods that we've witnessed in recent years. Prior to 1996, we never experienced more than 2 floods a year. In 2022, of course, we had the KZN floods, which were devastating. We had 8 floods that year. And also in 2019, we had 4 floods, and 2023, again, 4 floods. So even if 2022 was an outlier, there is a clear trend of worsening natural disasters. And if we don't solve this problem for natural catastrophe pooling or natural catastrophe alternative risk transfer, we might find ourselves in a predicament similar to America. We don't want to end up like them. They can't even find insurance for their homes. So the question then is, why do we not have a natural catastrophe pool? We touched a lot on regulations, and we will speak a little bit more about what we can do to enhance those. But a big limiting factor in South Africa is the SAM framework. We love SAM, but it's very restrictive. SAM was not built with pooling structures in mind, so we don't fault it for this, but there is no structural recognition in SAM for a pool. What this means is, if you as an insurer would like to form part of a pool, you are not going to be able to take account of the diversification of pooling risks across multiple countries. So if you have weakly correlated risks that you can pool together, the risk of one claim occurring at any one point in time will be less on the collective balance sheet, and you should be able to take account of that diversification. Under SAM, you're not going to be able to do that. The only options you have available is either you go for an internal model, which is very onerous, or you can try and use the SAM FSIs to justify a lower cost of capital, but the auditors are not going to be very happy with you, and they'll definitely ask for some overruns. Another broader issue with SAM is outdated parameter calibration. This is not directly linked to pooling, but the parameters under SAM, again, I'll bring it back to the KZN floods. Flood risk in SAM under the natural catastrophe risk module is covered by 3 in 1 10-year events and a 1 in 20-year event in the same year. The KZN floods were estimated to be up to 1 in 100 years on the coastline and 1 in 50 years inland. So this highlights the need for a review of the parameters that we are currently applying on the SAM in our SAM natural catastrophe module. If we can get this right, the benefits are good. The first one is a lower cost of capital. I know it's also exam week, so a lot of you should know that cost of capital is not free. Your office premiums that you will pay has a cost of capital loading in that. If we can get that lower by using our diversification, then we immediately can transfer that risk into a lower premium overall. Another benefit of pooling all our risks together is a reduction in the reinsurance spend. Reinsurers generally appreciate one large placement up, which is more predictable and less volatile for them. And we also have the added benefit that we don't have to negotiate separate reinsurance treaties for each separate insurer. If I negotiate on one, I save at least on admin costs through economies of scale. So what can we do to address these issues that we've raised? The government, of course, has a big role to play here. Part of the blocker is the lack of regulations or the lack of specific pooling regulations. The government can act as a facilitator and enabler. They can also make coverage mandatory and through that way force a pool to form, essentially by setting up a pooling structure, similar to the Sasria example that we've spoken about. I have a further case study on mandatory cover coming up as well. They can also have fiscal incentives. So they can incentivize insurers to form part of a pool by offering them a reduction in tax rates or corporate VATs. They can also create market conduct legislation. And if they are really strong, and we can go to National Treasury again with our arms outstretched, they can act as an insurer of last resort and step in and offer that capital to cover any risks that are extreme tail events. Other market players too need to come to the party. So we have industry bodies, insurers and reinsurers, brokers and intermediaries. On industry bodies, we've got the CEO of SIA here, she will also speak shortly. And they need to come together for a unified approach to solve this problem. Industry bodies will need to issue guidelines for pool administration. They'll need to guide the government on the best way to make this happen in an efficient manner. Brokers and intermediaries can champion pooling with their clients as a private market solution. And they also will typically have a lot more specialist structures, and they can assist with modeling of these risks in turn. Insurers and reinsurers, of course, will form part of the pools and they will seed the capital. Reinsurers also can provide technical assistance and financing and help set up the pool rules, since they would be familiar with these kind of structures that operate in foreign jurisdictions. We'd like to touch on a few case studies, some examples of successful pooling structures in the world. There's plenty to draw from. We've spoken a lot about the natural disaster pools and the success and amount of payouts that they've been doing. One example that we want to draw on is the Australian Cyclone Reinsurance Pool. The way this pool works, it's a mandatory reinsurance pool, very similar to the way Sasria operates in South Africa, where if you buy an insurance contract, part of that premium will go to Sasria to cover you for these uninsurable perils. In Australia, it's the other way around. So insurers now will need to go and seek that reinsurance cover mandatory through a single reinsurer. And the government steps in as a backstop for any risks that the reinsurer cannot cover. This was not something that was difficult to come to an agreement to. The private market had limited capacity for cyclone risks, just given the amount of the frequency of events that happen in Australia. Reinsurers as well did not want to carry that risk on their balance sheet, so they were more than happy to pass it off to the government. Measured impact on premiums. This pool is not old, it's very new. It's effectively since December 2024. So less than a year old, and already they have seen average reductions of up to 25% in insurance premiums for household cover, especially where pre-pool prices were really high. So areas where they were very prone, the insurers had to load the premiums with that risk of payout. And now that could be removed and offset to the government, they are seeing that impact come through. I want to hand over to Yusuf. Yusuf Bodia is here with us, Head of Finance and Investment from the African Risk Capacity. He's going to explain why we're not part of the African Risk Capacity, but Lesotho is, and other things.
Thank you. So a few weeks ago, Marius and Mo called me and asked about African Risk Capacity, and they said they were putting a paper together for this year's convention, and they'd like to get some insight into it. And after an hour of speaking, they said, why don't you just come to the convention and tell everyone what African Risk Capacity does? And I say that because we could have probably spent half a day speaking about what ARC Limited does. Our acronym is ARC. And I'm going to try and summarize it in less than 10 minutes as to what our purpose is and how we make an impact across the African continent. So when I joined ARC July last year, a colleague explained to me what ARC actually does or how it actually operates. And the way he explained it to me is he said, imagine ARC as a house cat or a domestic cat, but with the shadow of a lion. Now, I know that all of us work for organizations where we believe our organizations are small and nimble, but we roar like lions. But as I go through the story of ARC, I hope I can explain why this company roars or it has a shadow like a lion. So I'd like to start off with the problem statement first, which is climate change in Africa. As we all know, climate risk events or climate events are becoming more extreme, more severe, more frequent, as the flood stats showed, and more expensive. And it's sad to say that the African continent is paying the highest price for something that it didn't actually contribute to. And that's the purpose of African risk capacity. Our purpose is to protect the lives of the vulnerable Africans across the country. So just as context, there's about 1.5 billion Africans living on the continent, and it's estimated that 700 million of those Africans are vulnerable to climate change, which is more than or about half of the African continent. Those are the poorest of the poor, the people who can't look after themselves if a disaster hits and really needs the assistance from pooling arrangements like we have. Now, one could say that traditional insurance could work to look after them in the case of a natural disaster, but the shortfalls with traditional insurance for developing countries is that it's too slow, it's too complex, it's too narrow, and just way too expensive. And that's where parametric insurance comes in, and that's the solution that African Risk Capacity, or ARC Limited, has created for the African continent. So maybe just as context to how ARC was created, about 12 or 13 years ago, the African Union met and created the African Risk Capacity Agency, or ARC Agency, that looks after those 700 vulnerable Africans. And as part of the creation of the ARC Agency, ARC Limited, the insurance arm, was created. So our mandate is specific to provide disaster relief for climate events to Africans across the continent. If I give context to how parametric insurance works, and I know Mo explained it, but the way I would explain it is, it makes sense to me as an accountant. I'm not an actuary, so I'm not as smart as most of the people in the room here. There was an earthquake in Morocco, September 2023, and it was quite high up on the Richter scale. And insurance payout, a parametric insurance payout of over $200 million was paid out in a matter of days to the government of Morocco. Now, by no means was that more than $200 million claim sufficient to fix what was broken, but it was a small glimpse of what could happen if parametric insurance is used as a starting point to protect the lives of those who need the assistance. We are registered in Bermuda as a Class 2 insurer, and the reason we are registered in Bermuda is that there's no African country or regulator at the moment who can accommodate the type of product we service. For example, parametric insurance is slightly problematic in South Africa at the moment and in other African countries as well, but our intention and hope is that we do find a home for us somewhere on the African continent as well. We are a mutual insurer, so our policyholders are our shareholders by definition, but our policyholders do not really pay for any of the premiums that they purchase. We received seed funding from the British government and the German government to the value of $100 million 12 years ago. That is meant to sustain the company in the medium term, and hopefully over the long term we can generate sufficient profits to take us into the future. And our main purpose is to bridge the protection gap for those Africans who cannot look after themselves. So maybe going into the types of products that we provide. The first product that we provided, and sorry, I don't have any slides. I thought just speaking to it and keeping this African map would be the most effective. The drought product is the first product that we created, and that's been the flagship product for the last decade. We also do have a cyclone product and outbreaks and epidemic product. And very close into the future, we'll be having a flood product as well. And we've recently launched a Sharia compliant or takaful cell as well to cater for most of those in Northern and Western Africa. if I look at the slide, you will see that the third bullet point speaks about users' Africa risk view to link satellite rainfall with vulnerable data for fast, transparent payouts. Now, how do we pay out claims? We monitor rainfall patterns, cyclone patterns, wind patterns, and based on that data, we would be able to predict we'd look at a season and determine if a season has a drought. And as the season progresses, we know what our payout for that drought would be. And once the season ends, we are able to make an enormous payout to the government of that country that's suffering from a drought to assist them with that. I'd like to maybe just put some numbers into context because we're speaking about this concept, but not knowing how much it actually is worth. So our annual premium for this year is about 50 million US dollars, which equates to about 800 million rand, which is about 1% of the insurance market in South Africa. So not that big in terms of insurance, but does have a big impact. We've paid out more than $250 million worth of claims over the last 10 years. And not to make anyone nervous, but our loss ratio for all 10 years combined is over 100%, which is not something you'd like to see from an insurer. But it shows that the impact has been made. The need is there to pay out these insurance claims, and we've paid out those claims fairly quickly, sometimes within days. As an example, Tropical Cyclone Chido hit the Indian Ocean, was it last year, December, and one of the countries received a payout within a few days. In terms of claims paid, I mentioned that we paid out $250 million worth of claims over the last 10 years. And going back to Mo's example of the floods over the past few years, $80 million worth of those claims, or 1/3, was just paid out in the last year. So there were severe droughts that hit the Southern African region between 2023 and 2024, and Zimbabwe was one of the beneficiaries of those big payouts. Now, just to answer the question that I'm hoping everyone is waiting for, why isn't South Africa a party to this agreement? And the short answer is just lack of political will. If there was political will to take part into this program, we'd have South Africa as a country or a participant or a policyholder. And like it was said earlier, Lesotho is a policyholder to this program and has been benefiting from it quite a lot over the past few years. Now, just in terms of the business model, some may ask, how do we sell premiums to an African government that can't afford insurance premium? Many African governments don't understand how insurance works, to be honest, and even if they do understand it, the trust with insurance is not there within Africa. And what we've been able to do is issue policies to African governments, but get non-profit organizations to pay the policies on their behalf. And even if the African government does not trust the insurance and still doesn't want the non-profit to pay for that insurance on the behalf, we'd issue the policy to the non-profit directly, like the World Food Program, and when a claim triggers, we'd pay the funds directly to, in my example, the World Food Program, and they would use the funds to purchase food and goods, etc., for the people that need it most. We do transfer our risk quite extensively across the globe. We have about 15 reinsurers on our panel. We use quota share and FAC cover currently, and many other structures were used in the past as well. I'd like to maybe just speak about some of our challenges. Now, with climate change, we've seen that these are becoming more severe, more extreme, and more costly. And the biggest challenge that we have, or the two biggest challenges we have, is data. We have data for the past 10 years based on our own history, but going back hundreds of years is quite difficult. So data is one of our biggest challenges. And then secondly, funding. As much as we've received seed funding from the British and German governments, respectively, 10 years ago, funding has been a very big challenge for us. Just as context, we used to receive funding from the US government as part of grants, but that obviously stopped when the new administration took into effect. Like I said earlier, when Marius, Mo, and I spoke a few weeks back, we spent over an hour speaking about this, and I could probably write a book about the case study, the purpose, the reason why we exist, and I tried to summarize it in all of 9 or 10 minutes. But I hope that from what I spoke about today, that I've given everyone a glimpse of what African risk capacity does, our purpose, and why that this house cat or domestic cat actually does roar like a lion or has a shadow of a lion. And I'm happy, perhaps after the session, to speak more about it. As you know, I'm quite passionate about it, as you can tell. We have 30 staff members, most of which are actuaries, and they also would be very willing to speak to anyone in the room if you'd like to understand about it more. I hope this has given you a snippet of what ARC does, and keen to engage later on it as well. Thank you.
Good afternoon, everybody. So, I need to go. I was asked to talk to the case study of the South African nuclear pool. And I will expand a little bit on the next slide as well about what roles are involved. So in South Africa, the South African nuclear pool insures essentially Pelindaba and Koeberg, the two nuclear operators in South Africa. And as Marius has said, the clients are Nexa and Eskom. So let me go on to the next slide. But before I go into detail in this slide, one of the questions that I was asked to answer as well, and I think that there has been a lot of mention of what is the role of government, what is the role of insurers, etc. Is it simply government-led, is it a private sector-led, etc. So the South African nuclear pool came about because of the requirements of the Nuclear Energy Act in South Africa that requires the nuclear operators in South Africa to have insurance. Now, the nuclear pool is not as complex as I think that a climate risk pool would be, although it is very complex, simply because nuclear risk is not going to happen with a frequency, a known frequency. Whereas climate risk, we do know for sure. It's going to happen more and more, and it's going to be severe. The issue with nuclear insurance is the fallout of a nuclear incident is huge, and therefore there is this pooling system across the world, and as well as, in South Africa first, and then across the world in terms of the reciprocal relationship with other foreign pools. Now, as you can see from this slide, I wanted to first to sort of add to Yusuf's answer to the question, why isn't South Africa part of the African risk facility? And that question we have asked, and we have been, as the South African Insurance Association, been asked to consider on behalf of our members, what would be the advantages? Is there any appetite? And I agree with Yusuf that it is probably about political will, but I have a little bit of a positive aspect to add there. From a South African Insurance Association point of view, we obviously, our mandate is to look after the sustainability of the non-life insurance industry, and we do it collaboratively with government and with the regulators. And a big part of this sustainability mandate of ours is to look at potential uninsurable risks. Sometimes a risk can become uninsurable because it is not affordable anymore. And then there are obvious risks like climate change and so on. And what we have experienced as responses from our government, and I think that we need to recognize that as an industry body, we certainly do, that they would prefer, before government steps in, that the private sector solves for insurance risks. And I think that is something positive for our market. Only when the insurers really do not want to insure a risk, that is where government will play a role. And I think that is something that we as the Insurance Association appreciate. And it also makes us a little bit different from other jurisdictions, in my view. We also, what makes us different, in my view, is that we have a very strong and sophisticated insurance market in South Africa, an insurance industry in South Africa, insurance companies in South Africa. And I think because of that, in a way, we are a little bit more traditional and a little bit more risk averse in taking on different solutions and just different risks. the role of parametric it's really essential. We've been pushing for it for a long, long time, and we're hoping it's going to find a home, a permanent home in the regulatory framework, which the Prudential Authority and the FSCA are already currently trying to learn more about. And therefore, insurers can apply on an individual basis for a specific reason, and then be allowed to potentially underwrite parametric insurance. So to come back to the South African nuclear pool relationships, you will see in terms of this slide, it is not as easy. There's quite a complex relationships. And it is simply, well, one of the reasons is because there is not really a regulatory home for pooling arrangements. And that is true of many other jurisdictions as well, but there are some jurisdictions that does include pooling arrangements in a regulatory framework. So if you follow it, and the South African nuclear pool was originally formed by the South African Insurance Association at the request of our members. And that started in the mid-1980s. And obviously apartheid at its height, and there were lots of, unrest and all sorts of things going on. And the insurers then did not have an appetite to insure this risk, which was huge. So it was a pooling arrangement without a regulatory or a legal identity. And it operated like that quite successfully, also from the start with reciprocal relationships with other international pools. And there's lots of well-established relationships in this arrangement. But regulation moved on. In South Africa. Specifically, we all know we have a very well-regulated financial sector, an insurance industry, insurance sector as well. On the one hand, and on the other hand, we have South Africa has a very strong role to play in elevating corporate governance. So in terms of a pooling arrangement in South Africa, currently, the pool doesn't have an identity. So how do you enter into contracts and relationships and so on? So that is something that we have wrapped our mind around. And in around 2009-10, Kabelo, I'm correct, there was an agreement by the pool members that potentially to create a legal entity, we need to consider to create a nuclear administration pool, nuclear insurance pool administrator, which is a PTY Ltd, in terms of the Companies Act. So there is now an entity that SAMP, the pool, can delegate certain limited authorities to, and can enter into agreements and in terms of the Companies Act. Now, that brings a lot of complexities as well, as we've recently found, and that in terms of the corporate governance requirements of the registered company, the administration company, there are certain things that they must do. So this is not a full-time job. But there are certain functions that people must perform. The SAMPA, which is the administration company, has a board. And in the board, there are some shareholders as well. But they have no people, they have no resources, they don't have an office, and this is not a full-time job. So they then need to second resources, human and operational resources, systems, and so on. And because of the historic relationship with SAIA, between the pool and the administration company, there's a secondment agreement in place between, and we are renewing all of these things to up the game in terms of regulatory compliance with the help of KPMG. Thank you. So the seconded personnel from SAIA into the South African Nuclear Pool Administration. So recent discussions in trying to become a regulator, more compliant regulatory-wise, and on the basis of this slide, where you can see there are all sorts of different relationships. There's a relationship with Lloyd's, with a Lloyd's syndicate, which there is a dispensation for in the regulators. But then there are other pooling arrangements. So there are foreign reinsurers. There are local insurers that are part of the South African nuclear pool. So there are a lot of elements in the Financial Sector Regulation Act environment, both on the market conduct side and on the prudential side, that hasn't been thought through, and that the regulators definitely starting to think through these relationships to make it a little bit more easier for the pooling arrangements to find a place. Now, it is very it's not very complex. It's complex. It took me 2 years to understand it, by the way. And the fact is, in actual fact, if the pool actually has an identity, there's no need for that administration company in between. And so that makes it a little bit complex. There's always going to be complex relationships here. But it works very well. And the government's role here is the legislation require the nuclear regulators to have insurance, and that's the part that government plays. Further, it is a pool of private sector insurers, and with relationships to international pools. So it's an example of how it can work very well, but how it can be simplified if there is a home in the regulatory framework of South Africa. So we are also using this example as the value of pooling in South Africa, the place for pooling in South Africa, because we all know there are serious climate risks that is almost certain to happen, or are almost certain to happen. We learned from the pandemic experience as well, where worldwide, in fact, we've done a lot of research around that. There's always there are different ways of which one needs to insure these things. So we are very much in support of finding a regulatory home for this, and we are very supportive of pooling arrangements to address potential uninsurable risks or systemic risks for the industry, because that is something that is a big part of our mandate in South Africa. The role of the insurance association, the role of the industry body in this whole scenario, in our view, is very, very important. We are looking at the risks and mainly also systemic risks. And on the one hand, but we are looking at opportunities also for our members to become more sustainable. So if you look at the opportunities, we know that the government is looking at all sorts of green energy solutions, and there's a big plan there, and nuclear insurance is a part of that plan. So there's a lot of opportunities for our members to come on board. If there's a simpler regulatory environment, and for example, the mention of SAM, that is very important. We would have more appetite from our members to participate in such pools, and it is a necessity to have these pools as an option going forward. And I think I will stop there. I see I've used up way too much time. Thank you very much, and I hope it gave you some idea of our thinking.
Thank you very much, Vivian. So to summarize, we've identified there is a risk in South Africa of an increased natural disasters and a widening insurance gap. We've given a model that has worked in multiple countries through parametric insurance and natural catastrophe pooling. We have a blueprint in South Africa through the South African nuclear pool that we can actually do this. Now the call to action is that everybody should think a little bit more about this and do what you need to do to make it happen. The regulator, I don't think, is here, but if they were here, that would have been a first prize. We want to leave you with one last joke before we open up for any questions. And questions. This is too fast, sorry. Oh, you can't read it. Okay. You come to me afterwards, I'll tell you. I'll tell you. Maybe I summarized too quickly if there's no questions.
Thanks for the talk. Lots of information to digest. What would be the next step to create a pool? Do we simplify the nuclear one? Do we talk to government? Do we do something as insurers? Do we talk to Lloyd? What would be something that we can do to accelerate a body like this or an entity like this?
Thank you for that question. I think it's an important question. So I would like to share with you that we have been talking about these things with the regulators and National Treasury for a long time. And there is definite understanding of the need for it. And I explained cut short the role of the insurance, the industry body. This is something that the industry body should be advocating for, looking for. Clearly, we need our members, the insurers in South Africa that belong to SAIA. There needs to be a need for such a pooling arrangement. And usually then the South African Insurance Association will put something together. We already have, and I didn't mention before, Mario spoke about SASRIA. SASRIA was originally started as an insurance pool by SAIA members and SAIA, establishing it. And eventually, it became a government facility, which working very well. So we do believe that there is a role for government to play, because in some of these, we have serious droughts. We're talking about floods, and it's really going to increase, and it already is. But droughts also go with fire risk, which we are also seeing an increase of. So potentially there needs to be some sort of, the government must play a reinsurers of last resort, or there can be some subsidization model, because the private sector, we have looked at these models from a SAIA point of view, will have appetite up to a limit, even if it is a pool. And then there's a role for government to play. So this is something that the insurance body works on. We have done some work on it. We are advocating for it. We are talking to government. And National Treasury is really finding a role for SAIA in all the disaster resilience plans and frameworks, and those kind of things, the role of insurance. So I think that is something very positive to share.
Maybe just to add, the relationship with the global counterparts for that particular class of risk would also be important. So for most of these risks, there are pooling arrangements in other markets. And so a good step would be to liaise with them. The nuclear pool in South Africa, for example, the British nuclear pool played an important support role in the early formation years. So it would be important to build those relationships as well, because they play an important role for the offload of the risk.
Can I just add something? So SAIA is also a member of the Global Federation for Insurance Associations. So especially during the pandemic, and then they have all systemic risks committees and so on, work groups. SAIA is very active in there, and in a way, we share a lot of these kind of ideas with our counterparts in the rest of the world. So those relationships are there. It will be easy to establish these links, but it's something that we need to definitively decide And then I think it's not that difficult to put them together.
Thank you very much. I think we are out of time, unfortunately, as the break has already started. But if there are any more questions, please do feed them through to the speakers through the people functionality on the app, or grab them afterwards before they disappear. Thank you for a very insightful presentation. Very important things to consider, from a sustainability angle and from a social angle as well. So, as I mentioned, next there will be a refreshment break. So. Sponsored by Communicate Recruitment. If you guys haven't, there's also be some chess action again. And if you haven't gone to the stalls and the exhibitions yet, please do make your way around there. And after the break, please join us in the ballroom. There will be the plenary session taking place, and you will see Gugu there again. And thank you very much, and see everyone here tomorrow.